Hi, everybody. My name is Jen MacLean. It's such a pleasure to be here, and huge thanks to Creative Victoria and to the GCAP team for an amazing conference. I'm really excited to speak with everyone today. So I'm going to be talking to you about money. And I'm not going to be telling you exactly how to raise money, but I am going to be telling you the pros and cons of some different kinds of fundraising that you can go through. I'm going to sound really cynical, and I'm going to sound like I hate investors. And that's not true. But I believe that investors are great, because I believe that game developers deserve a fair salary. Here's the thing, though. If you go into conversations with investors and you don't understand exactly what they want and what they're willing to do to get it, you are going in at a huge disadvantage. And that is not healthy for you. It's not healthy for your business. It's not healthy for your games. And so I want to help you try and avoid that. A little bit about me. I've been in the games industry for 25 years. I have held just about every kind of business position imaginable. I'm now the executive director of the IGDA and the IGDA Foundation. And in those 25 years, I have been directly involved in raising over $150 million in various kinds of transactions. I have direct experience in 6 of the 7 models that we're going to talk about today, on either the funder side or the recipient side. The one model I don't have experience with is crowdfunding. So, sorry, I got most of the way there. When I think about funding, I think about funding as a quest. I find that when you go about your day-to-day activities, if you kind of think of them as quests, it makes it a little bit more fun. And here's the thing. You're going to encounter a whole lot of NPCs as you think about funding. And just like you have some NPCs who will give you fetch quests and other NPCs who will give you kill quests, all of the NPCs you encounter in funding have very different perspectives. They have different things they want. They have different things that motivate them. And I think it's really important that you understand this. One note, as we go through the talk, if you have general questions about the type of funding, please raise your hand and we'll answer them now. If you have a specific question about your situation, hold it to the end and just be respectful of everybody's time. So first and foremost, when you think about funding, there are a few things you really need to keep in mind. Funding is super time sensitive. And by that I mean you need to be conscious not only of your funding needs and how that drives your behavior, but also the time sensitivity of the person you're negotiating with. Often you will have someone who can only invest in a certain limited window of time, maybe for tax purposes, maybe for other purposes. You'll have someone who's only interested in a certain type of investment in a certain limited window of time. And timing is so important in raising money. I can't stress that enough. The other thing to keep in mind is, we consider ripple effects throughout the conference, is that when you pursue a certain type of funding quest, you may be closing off future quests. The decisions you make may have lasting consequences for your company and for your product. And it is really, really important to consider that. Because when you're wondering how to make next payroll, you might be desperate and willing to take any funding, but you could be setting your company up for a ripple effect that could have devastating consequences. You also have a lasting effect on your character, on your company, if you will. So just like you get experience points, you get XP for completing quests in an RPG or an MMO, you get types of XP for completing funding quests. And this will shape your business. It will shape how you approach deals moving forward, and it will shape the deals that are available to you. The thing about funding and about business in general is that your reputation is so important. And while it is okay to go through failed funding It is never okay to behave in an unethical manner. Trying to cheat, to hide details from your funders, to paint a picture that is not accurate, those are huge, huge problems that will come back and be far more devastating to your character, to your company, than not succeeding in your funding quest. So here's some of the boring, wordy parts, and I apologize in advance. It is really important to think about what you want and what you need. And the type of financing that you will be looking for is often driven by time. You can be looking for short-term financing. So for example, we know our product is about to launch. We know it's going to launch. I bet my life on it. And we just need enough money to get us there. You might be looking at something that is more medium-term. Well, it's not going to launch for at least 90 days, or it might launch, but it might not, or we're not really sure how well it's going to do. And then, of course, there's long-term financing where you need more than 6 months of runway. You also need to think about what you need besides money, because money sounds great, but it never solves all your problems. Do you need help finishing your game? Do you need help marketing the game? And also, do you need help managing your business? And this is super important when you think about growing your business, right? So if you are looking for capital, for funding to move from a company of 20 people to a company of 100 people in 2 projects, that's a huge overhead, not just in terms of finances, but also in terms of management. And you need to ask yourself, even if I got a check, would I be able to do this with the existing team, the existing resources that I have today? Often the answer is no, and the answer to all of these questions will impact the kind of funding quest that you pursue. So in trying to make this a little bit more interesting, I thought it would be fun to consider potential investment models as NPCs. And to really think about how they bring their different personalities, their different characteristics, the different things that they want and need to the approach. We're going to be talking about 7 different models: publishing deals, venture capital, crowdfunding, private equity or private company funding, angel investment, bootstrapping, and government investment. Now, this is by no means a comprehensive list, but a lot of the other approaches, things like getting personal loans or trying to do something fancy with listing on a stock exchange, I think are not relevant to the vast majority of people in this room. So the first NPC I want to talk about is a game publisher. When you work with a great game publisher, they can do amazing things for you. It's like magic. They can make your hardest problems disappear and help your game be more successful than your game could ever have been without them. When you think about what a publisher wants, they want high sales, because odds are they're going to have to report it to their investors. They want ongoing revenue. You know, we do not work in an industry where a game is launched and then forgotten. And they also probably want a strong IP. Now, I say probably for a few reasons. Most, but not all, publishing deals give the publisher some stake in the IP, if not the entire stake. Even when the publisher doesn't retain any rights to the IP, they often have a right of first refusal for your next game. So if your game does really well, odds are they are going to want to kind of draft on that for your next title. For a publisher, budget is extraordinarily important because that is cash coming directly out of their pocket. And in order to succeed in your publisher relationship, you have to have mutual trust. If your publisher does not believe you when you say, yes, we've hit this milestone, or even worse, if you do not believe your publisher when they say the check is in the mail, this relationship will not work. So specifically, publishing deals are best for long-term funding. They are best for helping you get a project from start or fairly early in the process to completion. A publisher can give you fantastic help in marketing and releasing the games. And great publishers also are extraordinarily helpful in shipping the game. You know, it's not uncommon for a publisher to say, hey, you've got a really tough performance problem in this console. I'm going to send one of my top engineers to go work on site for 4 weeks or however long it takes to fix it. Publishing deals are really bad if you have immediate cash needs because publishing deals take a while to get done. You know, in an example from my personal experience, we got the verbal, yes, we want to sign this AAA RPG from a major publisher at the beginning of August. The deal closed in December. You can imagine the cost to support that 80-person dev studio for those number of months while we were waiting for the deal to close. Publishing deals are also not good if you have a strong desire for creative control. Because guess what? At the end of the day, the publisher is writing the check. And the person that writes the check gets to make the final call. Often you will have that respectful relationship with the publisher, but not always. And if you have a very rigid production philosophy, if you believe firmly that this is the way you make games, and you want to work with a publisher, you better hope that publisher adheres to the exact same philosophy, because otherwise this is not going to be a good relationship. Because again, the publisher writes the checks, they make the call. Publishing deals require a really high level of ongoing management. Expect code archives, milestone presentations, significant demos. You must work within the publisher's system, and you cannot expect them to work within your system. The publisher's interests will always come first. If the publisher's game slips and moves into your launch window, guess what happens? Your game gets pushed. Doesn't matter if you were really hoping on that release bonus to make your payroll. Oh, well, too bad. IP ownership, as I talked about earlier, is usually but not always a concern. There are, as in any situation, some publishers who are more beneficent wizards than others. It's really important that you do your due diligence when you consider signing a publishing deal, and you talk with other developers who are working with the publisher at the time, as well as ones who have released games in the past. One of the big risks working with a publisher is if you have one single point of contact there and that person leaves, you're in a really awkward situation. It is really important that you build support within your publishing organization, particularly at the executive ranks. And finally, and I think the thing that is most important for everyone to be aware of when considering a publishing deal is that publishing deals are treadmills. And once you get on, it is really, really hard to get off. So what I mean by that is a publishing deal will usually get you enough money to make your game. And that's it. Because the way the large majority of publishing deals are structured, the publisher recoups the cost to develop the game, the money that they put up for the game, before you see a penny. And guess what? That recoupment takes a long time, if it ever happens. So what generally happens is you sign a publishing deal, you release the game, about 3 to 6 months before that game is released, you are already trying to sign your next publishing deal because you have to pay for the burn rate of your studio. You cannot expect to sign a publishing deal and say, okay, great, we'll just do this one game and then we'll have creative control and everything will be wonderful, because that's not the way the economics work. That doesn't mean publishing deals are terrible. If you are comfortable doing games for a publisher, if you don't want to worry about things like marketing, if you don't want to worry about things like CERT, they can be fantastic. But you do have to be very aware that the publisher is setting you up on a treadmill. And they don't care about the long-term health of your studio once you ship the game. They care about the long-term health of their company. See, I told you I was going to sound cynical. So this, venture capitalists, with Big Daddy, as you know, Big Daddy was fine until you threatened Little Sister. With venture capitalists, they're fine until you threaten an exit. Because at the end of the day, the only thing a venture capitalist cares about is a successful exit. They may seem like they're a great friend to you if they believe that you are threatening the company's successful exit, you will be gone so fast it will make your head spin. Team matters only to the extent that the venture capitalist believes you can deliver that successful exit. And as soon as they don't, team doesn't matter anymore. Now, venture capital can be a source of tremendous cash, $25 million or more. If you look at companies like Magic Leap, they've raised hundreds and hundreds of millions of dollars. They can be great help with long-term funding, and they can bring really great resources when it comes to help running the studio because they want to protect their investment. But they will protect that investment above all else. Here's the other thing about venture capitalists. They're really afraid of looking stupid. And so what that means is they tend to be very trend-driven in terms of how they make investment. I was going out looking for money for an MMO in the summer of 2011 when Zynga was just IPOing and when Star Wars: The Old Republic released to, unfortunately, underwhelming performance. Wow, you want to talk about a tough market. You had the super trendy, data-driven Facebook mobile game Zynga and MMOs. You could have pitched the next iteration of World of Warcraft and it would not have mattered because venture capitalists saw everybody investing in Zynga and getting this really great, big, shiny exit, and they saw the Old Republic not doing so well, and they would not invest in an MMO no matter what. VCs often invest in groups, so you will have what's called a lead for a round of investment, and that's the firm that essentially sets the terms of the investment and takes the largest share, and then that VC will often bring in other VCs that they have worked with successfully in the past. It is very much a network of investment. And because at the end of the day, VCs are measured on their successful exit, they demand a high level of oversight. At least one board seat will belong to a VC. You will have a lot of contact with the VC outside of regular board meetings. And again, if they think that for any reason that successful exit is in question, you're gone. So crowdfunding. Crowdfunding sounds really nice and fun and warm and fuzzy, and you get to build community relationships, and that's so cute. Aww. And if you mess crowdfunding up, it can be a nightmare. I think crowdfunding has also gotten a reputation as a really great way to fund a game, but look, let's look at the stats. Games, and I pulled these numbers yesterday, so they're recent. Games have a 35% success rate on Kickstarter. That means that out of every game project started on Kickstarter, 35% got funded. The average Kickstarter project size, $20,000. That covers maybe 2 man months, maybe, if you are paying your developers salaries. So it's not enough to make a game. It's certainly not enough to release a game these days. It is probably not enough to do anything other than solve the most basic short and medium term cash flow needs. Crowdfunding also generally only works if you have a great brand already or you have a big name associated with what you are trying to crowdfund for. That's sad. And crowdfunding can be a huge expense. If you do any kind of physical goods, it is entirely possible that it will cost you more based on your time investment and your fulfillment costs to actually deliver on the Kickstarter or the crowdfunding than the money that you bring in. These are all really important things to consider when you think about crowdfunding and you think about how that could potentially play into your funding quest. So private equity, private company. Private equity, how many people are familiar with private equity companies? Okay, so just a few. Essentially, private equity companies are companies that buy distressed companies, make really big changes to turn them around, and then try to recoup their investment, try to exit, usually either with a sale to another company or an initial public offering. Often you'll have a company that is a public company be purchased by a private equity company, so take them private. They fix whatever the business problems are, and then they re-IPO. When that happens, the mindset of your private equity company is that you have to take fast action, you have to take brutal action, and you have to turn the company around no matter what. I consider them equivalent to Donald Odina in the Mass Effect series, who, as we all know, was not a very nice person. The other option is being acquired by a public company, and this sounds really great. This sounds like potentially even the best outcome. You know, a company like a Comcast or a Time Warner or a Disney says, hey, you're doing great work for us, we're going to acquire your studio, and they solve all of your funding problems, until this company that does not have games as a core part of their DNA says, you know what, we're not seeing the kind of margins in the games business that we expect, so we're going to go ahead and exit this business, even if it is profitable. I think Disney is a great example of what is a love-hate relationship with games that kind of feels like a ping-pong match. You're watching, oh, they like games, oh, nope, they don't, oh, they do, oh, nope, they don't. And the thing is, when it is your studio that is being acquired and then shut down, that is a really painful thing to live through. Oh, sorry. Now, when you think about potentially going the private equity route or trying to be acquired by a private company, and this is great for medium and long-term funding needs. Often when this happens, you will be given at least a year's amount of runway, although that runway may be significantly less than you think you need. And they'll also help with running the business because at the end of the day, it's in their best interests to make sure that your business is successful. If you like the way that you are running your business today, do not go this route, because these companies are getting involved often because they think that there is some valuable asset, a valuable technology, or a valuable platform, or a valuable IP or license. But the company is undervalued, so they can come in, acquire a distressed asset, acquire a company for below what its real value is, make some changes, spin it out again, and make a lot of money. In other words, this model demands significant change. This is also bad for a content-driven business because content can be so fickle. So if you have an amazing tech platform, this could work really well. If you have created Jen's Muffin Truck food truck sim, and you think this is going to be the next great IP, this is probably not a good model for you. Another thing that is really important, again, is to think about how your business plays into the private company that is potentially acquiring you. Because the less of a direct fit there is, the greater the risk that they may decide to pursue a different strategy entirely. Now, angel investors are interesting because angel investors tend to fall into two different groups. You have the professional angel investor. This is someone who is an experienced investor, usually what's called a HNW, a high net worth individual. And in certain countries, there are actually legal requirements that you have to have a certain net worth in order to participate in funding rounds as an angel investor. They expect a significant portion of their investments to fail, a small percentage to succeed. But they move forward not just because of the potential financial gain, but because they have other returns that they get from their investment. Often you'll see angel investors focus on a specific geographic area where they live. So you may have an angel investment community that is tied to a city or a region or a specific type of technology. And they make these investments both for the hope of future financial gain, but also to support this local ecosystem, to support this local talent base, because they see it as something that fundamentally helps their business or whatever they do during the day succeed. It helps keep local talent, it helps keep local creativity, local ingenuity. You also have personal angels, and these are people who invest for really crazy reasons, reasons that make no logical sense. This could be your parents or your brother who made a killing at the stock market. I worked for a company that was owned by a famous American athlete, and we were very successful raising angel investment, in part because people wanted to come hang out at his house and try on his World Series rings. We had one high net worth individual who is a hedge fund billionaire who said to us, I could give $3 million to my son and watch him blow it trying to run his own business, or I could invest it in you guys and he'll maybe learn something with you and I'm out the same amount of money either way. There's no logic behind that, right? And there's no explaining it either. So your typical angel investment is going to be between $5,000 and $1 million. It's usually best for short or medium-term funding. It's also good with companies with some sort of added value. So that added value might be your famous founder. It might be some really cool technology. It might be that you are potentially being an anchor for an industry in a city. And it's good for experienced teams. Angel investment is really bad for companies with large capital needs. You know, if you are looking at $30 million to ship your game, raising $3 million with angel investments is not going to be worth it, frankly. It's also bad for companies without experience in venture capital. And here's something that is really, really important to think about. The funding terms that you decide on for any kind of equity investment, so angel investment, VC investment, have a direct impact on any future equity investment. So equity investment means selling part of your company, selling shares in your company. If you agree, for example, to an anti-dilution clause in an angel investment, and that essentially means that, hey, I'm going to buy 5% of your company, and no matter how much else you sell, my percentage will never go below 5%, you are making it impossible to sign any future venture capital deals. And that's going to kill you if that's a model that you want to pursue in the future. So it is really important when you think about angel investments that you get professional advice, because otherwise you will find yourself on that exclusive quest path, maybe without intending to be. With personal angels, there are a lot of strings attached with that money. There are strings attached with all money, and that's really the point of this talk. But with personal angels, if somebody cuts you a check for $25 million, and if that someone happens to be your parent, and they say, hey, you're coming to our house for Christmas, right? You don't always have a lot of ability to say, oh, no. You know, if you work for a famous founder, and someone cuts you a check for $500,000 and they say, hey, you're going to be at my Christmas party, right? You don't really have a lot of options to say no. It is really important that you understand the strings that come attached to this money and ask yourself if you can afford to damage this relationship. That's a decision that you have to make. It's different for everyone and it's different for every relationship, but it is absolutely a key consideration with angel investment. So bootstrappers, this is somebody who is hiring your company essentially as a mercenary and who wants you to do work faster, better, cheaper than it can be done internally. This is a pretty common approach, doing work for hire for other companies, for other studios. If you have a good team that's already established, but you need to pay paychecks, you need to pay salary. The thing is that when you act as a mercenary, when you act as a work for hire, the person who hires you doesn't care about the impact on your personal project. They don't care at all. So if this means that you say, hey, we need to make payroll, so we're going to go and we're going to do, we're going to do level design, we're going to do 3 different levels for this other game, and that means that your project that you want to make, the one that you are most invested in, ships 6 months, they don't care. If you are trying to raise money while you are doing work for hire and you need a playable demo and you're trying to figure out how in the world you can meet your milestone for work for hire and get a playable demo, guess which one's going to slip? At the end of the day, the work for hire has to come first, and that's a really big trade-off. Now, this is best for anywhere from $5,000 to $1 million plus. For short and medium-term funding, you should not expect work for hire to help you ship a game and market a game and release a game, because you're kind of setting yourself up for crazy overwork. This is also really good for companies with significant technical expertise, because you can get a premium on the right technical expertise at the right time. And it's good for really experienced teams. This is not good for a company that needs a lot of capital, because you end up doing so much work for hire that you cannot make progress in your own product. It's not good for companies that have any kind of time sensitivity, and it's really not good for companies with a transient workforce. So if you have a team that is part-time now, and you want to try a work for hire approach, you need to think hard about what happens when your lead engineer, who you're only paying part-time, gets a really nice full-time job offer. That's going to put you in a really awkward position. The other thing to think about is that when you do work for hire, there is significant management overhead. You are essentially working with a client. You have to manage your team's work to that client's needs and expectation. And that can be a really huge chunk of time, energy, and resources, and even money. So you have to ask yourself, is this something that my team has experience in? Is this something that they have enough expertise in that I can cause a premium that makes up for opportunity cost? And is this something that the product can afford as well? If you have a live game and you are taking all of your engineers and putting them on work for hire, you are asking for trouble, and that's a real problem. Government investment. I was involved with a company that raised $75 million through a bond from a state in the United States, the state of Rhode Island. This is not normal, by the way, in any stretch of the imagination. But when you get some sort of government investment, it is usually much smaller, anywhere from $5,000 up, and it is often grants or tax credits. And an interesting thing about tax credits, kind of the way they work, is you may get tax credits for, say you spent $500,000 in a project and you get $500,000 in tax credits, but you only made $5,000 in revenue, so you don't owe $500,000 in tax credits. You actually sell them to businesses who apply your tax credits to their tax bill. It's this really strange kind of trading mechanism. At the end of the day, this can be really helpful. It can also be really scary. And what motivates government investment are 2 things. And I think this is true no matter what part of the world you live in. It is jobs, because every politician wants to see more jobs in their constituency. And it is jobs leading to re-election, because I feel confident in saying that every single politician around the world cares more about being re-elected to office than probably anything else in their life. Now, if you know that, you can frame the conversation in a very unique and specific way. You can make the argument to your city or state or even national government, although generally government investment works much better on a city or state or principality discussion, that, hey, by implementing this tax credit program or by doing this moral obligation bond or setting up this grant program, you are helping us not only build jobs, but build really good high-paying jobs. And you can point to other locations like Montreal or Austin in Texas that had one game studio that became 5 game studios, that became 10, that became 20, and that suddenly have created 10 or 20 or even 50,000 jobs. That might be a little bit of a stretch, but you'd be surprised at what politicians are willing to believe. This can end up being something that is a huge opportunity for you. However, if anything goes wrong, you will very possibly, in fact probably, be sued. You need to be prepared for some significant unpleasantness in terms of the press. And if you mess it up, you may inadvertently have consequences for your industry in that part of the geographic part of the world as well. You know, it is a real challenge because for every place like Montreal or Austin where you can point to a successful game development cluster that has grown, you can also point to places like Boston or even Baltimore where there was a successful cluster that has since contracted, and where you may have had 5,000 jobs and now you only have 500. So this is something where, you know, it is a little bit dicier, especially as you get bigger and bigger in terms of investment. That doesn't mean it's not necessarily a worthwhile conversation to have. So I want to leave you with a few truisms. These are the things that, if you remember nothing else, please keep these things in mind. First and foremost, every single person who gives you money expects something. It might be a great exit. It might be having your famous founder show up to their Christmas party. It might be job creation. Everyone expects something. The key to successfully raising money is to understand what the other person expects and to know whether or not you are willing to give them what they expect. Second, people are inherently over-optimistic. That applies to both your investors, but also to your perspective on your cash flow needs. We tend to underestimate the complexity of what we're building. We tend to underestimate the things that can go wrong. We tend to overestimate the financial performance of our products. All of this means that you will almost certainly need more money than you think you do. Also, get money before you need money, because your worst possible outcome is to be sitting there wondering, how am I going to make payroll? And to realize that your only option is to take a deal that could put your entire company's future in jeopardy. And then, finally, as we talked about with publishing, getting money always, 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 always takes longer than you think. So when you start that conversation with your potential investor or publisher or angel and they say, yeah, I think this can close in 6 weeks, double that. Plan for the funding to close in 12 weeks, if everything goes perfectly, because you will be shocked at the amount of hoops that you will have to jump through, no matter what funding structure you pursue. So especially given that you are already overly optimistic about when you're going to need the money, and you're getting money before you think you're going to need the money, again, plan for getting that money to take a heck of a lot longer than you might expect. So that was, in 40 minutes, everything that I have learned raising more than $150 million, and again, being both on the investor and recipient side. And I would be happy to take any questions that you have. So the question was, what should you ask investors, besides things like dilution, what are really important questions? So first and foremost, what's their time frame? If you are working with an angel, or even a VC, ask when they expect you to have a successful exit. If you are working with a publisher, ask what potential things could derail this. Ask what else is in your portfolio for the same 6-month launch window that we're planning for. Ask what, for government, there's an election coming up. How will that change this program? You know, if things don't go according to plan, if your party loses control, what happens when that takes place? And is there any danger that the program will be impacted? I think in general, asking as many questions as possible of anyone who wants to give you money is a really, really good idea, because at the end of the day, you want to understand what they want to get out of it and when they want to get that out of it, because those two things will directly impact their behavior towards you and how they act towards your company and your product. So we had another question here.
Great talk, by the way. I was just wondering, all this is super complicated and really weird. Do you recommend any resources to kind of navigate this process?
So the question was, this is all super complicated and really weird. Do you recommend any resources to navigate this process? The most valuable resource is a local entrepreneur group or a local angel investor group. At the end of the day, those local angels want to see companies succeed. They want to see you succeed, even if they don't give you money, because they know the more successful companies in your city, the better it is for everybody in the city. And you will be amazed at how much free advice these local investors will give you. Bringing in advisors who have successfully raised money is also a really great tool to learn more, especially if they have successfully raised money in the way that you are interested in raising money. If you're pursuing a publishing deal, talk to other studios you know who have done publishing deals for similar content. And really, you know, you can go to business school. I went to business school. It's probably way more education than you want. And there are so many people out there who really do want to give back to the community that often they will be happy to sit down with you for a few hours and say, hey, for your specific situation, here are things that you need to keep in mind. Here are other people that you should talk to. Here are other companies you should talk to. Here are other models you should think about. And that's really probably the best approach, as opposed to a specific deck or website or book or anything like that. Yep. So the response there was, while you are negotiating the investment, also negotiate what happens to you upon the exit, because that is a termination, so you're always going to want that termination agreement. And then lean heavily on a good attorney and make sure that attorney has experience that is directly applicable to what you're wanting to do. So if you are pursuing a publishing deal, go for a video game attorney. If you're pursuing an equity deal, go for a startup attorney. So the question was, if you were doing work for hire, do you think it's expected for your company to get credit for that work in a public way? Is that a good paraphrase? Yeah. Yep. It is not expected, and in my experience, it really depends on the amount of work that you do, as well as the partner that you are working with. There are some companies who are happy to have another logo up in the loading screen. There are other companies who, particularly if it's a mobile title and you tend to not get a lot of credit in general on mobile games just because of the real estate, they may not be okay with that. In general, asking for a professional reference is probably more important than doing something that is consumer-facing, and negotiating your non-disclosure agreement so that you can speak in at least general terms about the work that you did, because consumers probably don't care that much. But what you do want to do is be able to show the work that you've done in terms of a professional sense and in terms of being able to use it to get more work in the future. Yeah, so the question was, do you have any comments about joint ventures between different companies in the sectors? I think so. From what I gather, what some people might consider a joint venture, I might consider work for hire. So for example, if you are being asked to create a mobile title for Thor Ragnarok, that to me will likely end up being work for hire as opposed to joint venture. Joint venture is some sort of corporate legal linking between the companies. It can work, but joint ventures are kind of like a marriage. And just like all the other funding models that we talked about, it's really important that you understand what your partner in the joint venture is hoping to get out of it. If they're looking for a way to learn more about the games industry and share the risk, okay, that could work. But again, what is success to them? A great question to ask in any situation is, what does success for this project, for this hire, for this game mean to you? Now, for the joint venture, what is the success? Also, it's really important to consider how you get out of the joint venture. So you don't want to be in a position where you find that you've made a commitment to a joint venture that means you can't sell your company, or you can't take additional investment, or you can't release the product that you want because you have specific obligations to make, for example, commercially reasonable efforts to do something for the joint venture. That can get really difficult and really complicated. So it can work. At Comcast, we pursued a number of those, but you'll have the highest chance of success if there's very clear exit criteria, if there's a very clear way to unwind. And you've got to be really careful, because often the party that is putting up the large amount of cash will dictate the terms that they can unwind. And guess what? If I'm putting up the cash, they're going to be favorable to me, not you. And also make sure that you understand what the consequences are if things don't go well with the joint venture, because the worst thing you want to do is end up being sued for tens or hundreds of millions of dollars because your joint venture partner doesn't believe that you met your obligations. I'm sorry, I couldn't quite hear all of that. Okay, so the question was, how do we go about accessing investors? There are a few options. Again, first of all, check your local community. If you are interested, so first step is to figure out what kind of help you need, what kind of financing you need, what other help you need. And based on that, looking at the matrix, figure, okay, these are probably the 2 or 3 funding options that are best for me. In terms of, first start locally. So go ahead and see, are there local angel groups? Are there local government programs that could be applicable? Keep in mind that often local programs can be written, for example, for film, but can be applied, because of the way the law was drafted, to things like games. For publishers, there are a lot of resources out there on the web and also in the game dev community in terms of publishers to work with. Talk with your peers who have worked with publishers, or talk with your peers who have released games and ask, did you go with a publisher, did you not, who did you go with, why did you go with them? You can also just take a look at the app stores in your platform of choice. Talk to the platform owners. Hey, I would really like to, hey, Chris Charla, ID at Xbox, I would really like to talk to somebody, talk to a publisher, because I have this bigger game idea. Who do you recommend? I think that you can get an awful lot of value by word of mouth. And you will often hear through whisper networks The story that maybe you might not find shared publicly. So the question was, with a publishing deal, what do you think is a good amount of equity to keep in IP? Generally, with the publishing deal, with IP, it's all or nothing. So either you will retain the ownership to the IP and the publisher will ask for right of first refusal for a future title, or the publisher will own the IP. It's really hard to say, well, I get the IP for console platforms and mobile, but publisher, you get the IP for film, TV, books, ancillary products. Because what happens when you want to take those two IPs in that IP in two very different directions, right? That is a really hard negotiation. Not always true if you're partnering with a media company. So for example, if you were going to do a deal with a major TV company, they may say, we have rights to IP adaptations for TV movies, you have rights for games, but you still need to think very carefully about how you would resolve conflicts over IP, and also what happens for IP ownership for a platform that maybe hasn't been recognized yet, like augmented reality. You know, these are things that a good attorney will help catch, and they will put in appropriate language in terms of resolving it. But for a publisher in general, it's usually going to be one or the other. That gray area is a lot more difficult to find, especially if you are developing with an IP that doesn't have any established weight behind it. We worked on an IP that was created by R.A. Salvatore, who is a New York Times bestselling author, and Todd McFarlane, who wrote Spawn. So we were able to retain control of the IP, even though EA was our publisher. That's really unusual. Any other questions? Question was, what can we learn from Kingdoms of Amalur Reckoning? Here's what I've learned. You had an amazing team that did everything right. They delivered a fantastic game that outperformed EA's sales expectations. EA, said that in their earnings call. Did it on a ridiculously tight budget in a crazy tight timeline, and their studio is still closed through absolutely no fault of their own. And that is a really sad reality of game development. Sometimes you do everything right, and your studio still closes, and it's heartbreaking. It really is. And I wish that there was a way around that. One of the things that I think is really important for the IGDA to do is to help both individual game creators as well as game business people avoid those situations as much as possible, because it really is heartbreaking. And it's something that maybe if we all share those lessons and we all learn from each other's mistakes, and we all quite possibly don't take $75 million from the state of Rhode Island, we can avoid that kind of situation in the future. Not necessarily avoid government money, maybe avoid government money when you know it won't fully fund your massively multiplayer game. But yeah, I'm happy to talk about that more, maybe over drinks. Thanks so much, everybody.